Rob Mason with Baird. Your line is now open. I apologize. The next question is from Tim Long with Barclays. Your line is now open.
Thank you. Yeah, two for me as well. First, could you mentioned AI leading the strength in wireline, obviously a lot going on there, a lot of activity. Could you maybe expand a little bit on how big that business is getting for you and maybe some examples of newer areas that Keysight is being pulled into because of the move in AI? And then the second one, I just wanted to follow up on the software services, up to 39% of revenues here. Maybe just talk a little bit about that evolving part of the business model and how Keysight's going to be able to move that number further and maybe impact on gross margin as that moves higher as well. Thank you.
Thank you, Tim. Clearly, the wireline business has gained momentum this year, driven by AI. But this is one of the examples of proof of concepts that I highlighted at Investor Day last year. And so we're quite pleased with the way the opportunity has progressed. Our wireline business has exceeded over $1 billion in orders this year, growing at double-digit rates. And we service a broad set of customers in that industry, right? You think about silicon designers, system integrators, NEMs, hyperscalers, and contract manufacturers. So it's actually a broad set of customers. But what's driving the activity in AI right now is actually a concentrated set of customers from hyperscalers that are investing in large infrastructure upgrades. So that's the effort. And the supply chain right now continues to be constrained. So the investments are being made to unlock the supply chain to enable the scale to build. And so we're involved in that, and we're capitalizing on that. But as we think about the future, we participated in some forums like the OCP and ECOC earlier this year, and you can start to see the scale expand. It's not yet reflected in the results yet, but we start to build scale around compute, whether it's centralized or at the edge, power and thermal being very big issues for companies. Networking technologies are being adopted, maybe even faster than they were being adopted before this AI became a big trend. And our opportunities we're excited about are not just in the physical layer, but in the protocol layer, allowing customers to emulate how traffic flows through an AI infrastructure and therefore optimize their investment. So we're pretty excited about the opportunities long-term here and capitalizing on the near-term strength.
Yeah, and then as it relates to software and services, obviously continuing to see a nice mix shift towards those portions of our business. And, as I think a part of your question addressed gross margin, the software portions of those businesses are accretive to Keysight's average gross margin. The services portions are slightly dilutive to Keysight's average gross margin. But overall, both the service business has a lower expense structure, so both contribute nicely to profitability when you think about it from the operating margin line.
And then, Tim, I would just add, this is Mark, as far as the expansion. We've shown that it's more resilient to the current macro. Customers continue to invest in new methods, shifting left on virtual simulation and emulation of their systems to help reduce costs and increase efficiencies, and we're seeing that. And then the second part, of course, is the further leverage of some of our new assets like ESI being exposed to more of our customers in different regions, the U.S. for aerospace defense, parts of Asia, with the broad Keysight footprint in those regions. We see that as a driver for additional growth as we go forward.
Okay, thank you.
Thank you, Tim.
Thank you. The next question is from Rob Jamieson with Vertical Research Partners. Your line is now open.
Hey, guys. Congrats on the quarter. Just a couple of quick ones for me. Just first on the communications business, just what kind of benefit could we see from BEAD funding just in the second half of 25? I mean, is there much benefit there if that funding does get actually released and finally comes to fruition? And then I guess, also any potential risk of that, being reversed, just given some of Trump's advisors at this point that have been anti-BEAD funding.
Yeah, I think the good thing about Keysight's business model in comms, and in fact, the rest of our business is the broad set of customers we serve. That diversity and breadth is a source of great strength during times of change. And so, while we do pick up, some incremental business every year from new logos that come up because they're funded directly or indirectly, there are some direct funding from government at times that flows into Open RAN. And we've called some of those wins out and even the CHIPS Act, but we're not heavily tethered to any one of those things. So I would just say that those are incremental in some ways, but not as material as maybe the headlines would suggest, especially because we're more involved in the R&D side of those labs, and so we feel good. I think the momentum we see because of our renewed focus on go-to-market expansion that we had put in place with marketing is the continued attraction of new logos that we see across our business. It continues to be the focus for us moving forward as well.
That's really helpful. I appreciate that. And then I guess just on tariffs, just real quick, and just you guys have been dealing with this in one way or another for over 8 years. Can you just talk about your previous strategies around your pivots in the APAC region, just whether it's been Huawei, ZTE, or even the Trump tariffs, just how you've kind of managed that in the past?
Yeah, I would just say, it's probably the question behind the question, if I'm understanding you right, is what are the implications of the U.S. elections and therefore the policy changes that may ensue. And so, like everybody, we're monitoring 3 areas: tax, trade, both tariffs and trade restrictions, right? As areas, and along with defense spending that might ensue. It would be premature for us to comment on them, except to say that we've been pretty agile in ensuring compliance when there is a new government restriction and pivoting our sales resources to go after new opportunities. A potential offset could be, and again, I'm breaking my rule and speculating a little bit, is if there were to be tariffs of the orders being discussed, many companies are looking to more of China into other areas in Southeast Asia, and we remain prepared to capitalize on the opportunities should that occur.
Got it. So similar to like what we saw with reshoring and everything during supply chain disruptions, the benefit that we saw there.
Exactly.
Great. Thank you very much.
Thank you.
Thank you. The next question is from Rob Mason with Baird. Your line is now open.
Good afternoon. And again, nice jump on the quarter. Just with respect to your thoughts around 2025 revenue, Satish, I know you covered some of the segments, but just at a high level, I mean, is it fair to think you think all of your major, I'll say segments, again, we're talking wireline, wireless, automotive, general electronics, some of these verticals, would all of them have an opportunity to grow in 25, do you think, within the kind of mid-single digit profile that you're talking about? Automotive sounded like maybe it was the most challenged, but I'd just like to get your thoughts there around.
Yeah, that's good. Look, our job number one, Rob, was to stabilize the business and return to order growth, which we set out as a priority for the second half, and I'm quite pleased that we've executed to that. Now, looking at the facts, you'd say CSG has returned to growth for the full year from an order perspective, and EISG is yet to do that. So that sort of summarizes the mixed demand environment. And just projecting forward, we expect continued sort of slow, gradual recovery as we move into 2025. We're not baking in our base case all segments inflecting, and should that happen, we'll be prepared to capitalize on it. But our base case that Niels called out in his outlook section is for 5% revenue growth and 10% EPS growth for the year.
Yes. Okay, that's helpful. Just as a follow-up, and maybe this directed to Neil, just with the higher ESI revenue in the first quarter, I would assume that the gross margin, will reflect that at least sequentially. Could you maybe give us a little bit of thoughts around your OpEx as you trend in, from fourth quarter into first quarter? There's often some resets. I know seasonality as well influences that, but I'm just, kind of curious what kind of trajectory OpEx is on as you enter the new year.
Yeah, let me just touch on a couple of seasonality-related comments since you've opened the door to that. I think, first of all, as you mentioned, with regard to gross margin, with the sizable uptick in ESI revenue, we would expect some gross margin upside, from that business in Q1. Similarly, though, then as you move from Q1 to Q2, you have a reverse effect as that revenue comes out of the model. So just if you put it on one side, you got to take it out on the other side. With regard to OpEx, just reminding you of some things that are kind of the norm for Keysight. We do salary administration for the entire company here in the first quarter of the year, so that will be impacting the P&L starting essentially now. And then as the business inflects from a period of contraction back to a period of growth, we have essentially our variable pay programs turning back on, which will increase OpEx here starting in the first half of next year.
Very good. That's helpful. Thank you.
Thank you. The next question is from Matt Niknam with Deutsche Bank. Your line is now open.
Hey, guys. Thank you so much for taking the question. On macro, I'm curious if you can speak to how that backdrop has evolved over the last quarter. 'Cause it seems like there's some pockets that are getting better, yet it seems like others, like auto, that are maybe a little bit softer. So any general commentary on the macro backdrop you can provide? And then just as a follow-up on aerospace defense, can you talk about maybe what changed later in the quarter? You mentioned a very strong closeout to the quarter, particularly around the U.S. Just curious in terms of, what changed and how maybe that's trended into the start of fiscal 1Q. Thanks.
Yeah, why don't I start by making some comments about macro, and then we'll let Mark Wallace make some comments about the broader aerospace defense business. So first of all, as Satish mentioned in his prepared comments, the results in Q4 were marginally better than we expected coming into the quarter, and so I think that's positive. A lot of that strength itself was in aerospace defense, and so Mark will talk about that. But I think as you think about macro changes, and the previous question alluded to this as well, I think the automotive business is where we're seeing the most pressure, significant pullback in spend around EV development at this point in time, which is impacting that industry pretty significantly. I think if you look across broader strength in wireline, stability, maybe not yet a strong catalyst for growth in wireless, but at least stability, nice forward momentum in aerospace defense. I think with regard to semi, it's a question of timing. I think everybody's optimistic about a turn back on in semi. The question is, when does that really begin in earnest? And then the industrial end markets, maybe the biggest question mark, because I think some of that is going to be tied to how a lot of that capacity that was put in place during the 21, 22, 23 supply chain disruptions, over what time is that capacity fully absorbed and people start to once again reinvest in manufacturing capacity. So that's kind of how we're thinking through the end markets from a macro perspective.
Yeah. And Matt, I think the aerospace defense, as Satish talked about, the focus on defense modernization has remained a top priority in the U.S. and allied nations. We had continuing resolution in the first part of last fiscal year, the government fiscal year 24, which put some delays on new program starts. So as we entered into the fourth quarter with the government fiscal year end in September, we saw, increased spend as we would normally see, which was not certain because of delays in the budgeting process. So that was a big positive. We see continued investments from the prime contractors as well as the direct government in the U.S. and the prime contractors in Western Europe as well, as we've been talking about for many quarters due to the geopolitical situation that continues to unfold. So those factors come together. And then, longer term, I think the areas that are promising for us continue to be around EMSO, space and satellite, and quantum, with some of the government-funded research that's occurring in all parts of the world, continue to offer us opportunities over the coming quarters.
Thank you.
Thank you. The next question is from Samik Chatterjee with JP Morgan. Your line is now open.
Hi, thanks for taking my question. I guess for my first one, Satish, if I can go back to your comments earlier about not really embedding sort of inflection in all of the businesses in your 5% growth target for fiscal 25. How should I think about what kind of recovery or what your expectations are embedded in for semi-cap and general electronics? Seems like both are a bit mixed in terms of what you're seeing, but if you can just outline how you're thinking about those two areas in particular, and I have a quick follow-up after that. Thank you.
Thank you, Samik. I think for semiconductor fabs, just based on what we're seeing and the pipeline of opportunities we see for our wafer test solutions around silicon photonics and new memory topologies and some of the higher voltage types of wafers, I think that strength continues for us. In somewhat a little bit offset by, and that's the bigger part of our semi business, somewhat offset by a slowdown that a number of the semiconductor equipment manufacturers have reported as well. So you put that in the mix, we still think semi grows from these levels for us. And again, semiconductor is, as you know, is roughly 10% of our total revenue at the company level. From a general electronics perspective, what we've started to see, and again, one quarter doesn't make a trend, so I just want to caution you, but I do think in Q4 we saw stability in manufacturing, which finally resulted in the underlying strength in research spending around next generation technologies, the broad new customer logo, all of that returned that business to growth. Again, it's just one quarter, but we think that that stability in manufacturing continues as we move forward as well, which should give some, which should put EISG on return to order growth at some point in the year. It's difficult to call at this point.
Okay, got it. And for my follow-up, maybe this is more for Neil. I think, Neil, a question you're getting a lot from investors is when they look at some of your previous margin targets that were a bit more longer term for fiscal 26, you're not really that much different at this point from a gross margin perspective, where the guidance was 66 to 67, but you're significantly at a gap to your operating margin target of 31 to 32. How should we think about the drivers and sort of beyond volume leverage, how you're thinking about other drivers that get you closer to that target, or is there something that sort of needs to be evaluated relative to those targets? Thank you.
Yeah, I'd say a couple of things. So first of all, I think we're pleased with how gross margins have held up on the downside of the cycle. Obviously, we've gotten some benefit here from the addition of the ESI software business, but even if you look at the core Keysight business, the gross margins have held up pretty well in total on the downside of the cycle. I think when you start to think about those targets that we put out, 66, 67% operating margin targets, where again, we're 150, 200 basis points off of that at current levels. But we're significantly further off on the operating margin line. I think you need to look at the impact that the acquisitions are having in the short run, where we've made some acquisitions that are accretive to gross margins, but significantly dilutive to operating margins. And I think as we get those businesses integrated and start to operate them within the greater Keysight operating model, there's going to be opportunity for us to drive significant profit leverage on those acquisitions and start to close that gap on the operating margin side of things.
And Samik, we remain confident in the long-term growth opportunities of this business. And you've seen when we can deliver above model growth rates, the sort of earnings power and leverage we have, we continue to operate this business in a disciplined way to be able to realize those and get us back on track.
No, sure. Thank you. Thanks.
Thank you.
Thank you. The next question is from Meta Marshall with Morgan Stanley. Your line's now open.
Hi, this is Karan on for Meta. Congrats on the quarter. So just starting on the automotive side, clearly you remain quite positive on simulation, but outside of that, are there any other exposures that you have within auto that could cause a pickup in the business outside of maybe EV sales improving? And then I have a follow-up. Thank you.
Sure. Yeah. So there's several parts to automotive. The part that we're seeing the slowdown and project delays is around EV investments that have been quite robust over the last several years with battery test labs. So we're seeing a pause in that. We're seeing manufacturing demand also stay lower levels, but that's another part of our business that, as inventories normalize, that we should see some increasing flow through of manufacturing test for that. The part that's remained steady is the software-defined vehicles or the ADAS, the autonomy side, where we have continued innovation crossing over multiple parts of our business into communications, sensor technology, and so forth. And a lot of that is software as well. So there's a lot of work being done in that frame. And the other one that doesn't get as much attention, at least from these calls, but gets a lot of attention on the news, is the infrastructure. So the charging infrastructure and the standards associated with those in every region of the world represents, additional opportunities that we're pursuing. So long-term drivers of growth, secular drivers around AV, the manufacturing coming back on, new advanced technologies remains an area of focus for us, over many years.
Got it. That's helpful. And then coming back to the AI side, are there any areas that you see in your portfolio that you could maybe grow content or offer new products to sort of take advantage of the opportunity that you're seeing today? Thank you.
Yeah, good question. I think as we mentioned, the more logical areas which we have seen growth come from to date, or results come from to date, are associated with the physical layer tools where we provide our oscilloscopes, our sampling scopes, and other tools that we provide. And what we're seeing is a bigger opportunity for our emulation platforms. We're still in early pilots with customers on. Again, it's a concentrated set of opportunities today. We expect that industry and the impact AI is going to have to be broader. And we're participating in enabling the ecosystem with the right set of tools all the way from design, emulation to test. And our focus is on enabling our customers in the R&D parts of the workflow. And it's a pretty rich opportunity for us. Thank you.
Thank you. The next question is from Adam Thalhimer with Thompson Davis. Your line's now open.
Hey, good afternoon, guys. Congrats on the beat. And Mark, congratulations on your retirement.
Hey, thanks, Adam.
Wanted to ask first about the operating margin in communications. I think that was your best ever quarterly operating margin. It kind of took me by surprise. Curious what drove that and what the outlook is there.
Yeah, so obviously we are very pleased with the results in CSG. Gross margins have held up very strong in that business. I think we see not only do we see a higher software content, higher recurring revenue from software, which obviously helps margins, but I think there's less margin diversity in the CSG portfolio than we see on the ESG side, so less impact from mix. From a profitability standpoint, I think we're very pleased that we're keeping our foot on the gas on the R&D side, continuing to invest to position ourselves to capitalize on the upside while driving significant efficiencies in SG&A, resulting in the strong profitability that we saw. So it was the strongest profitability we saw this quarter, not an all-time record, obviously, but it's very strong operating margins in CSG this quarter.
And then in EISG, as you think about the full year, what are the growth offsets to the weakness in auto?
You're talking about in 24 or in 25?
For fiscal 25, what offsets
I think
in auto this year?
Yeah, I mean, I think as Satish look forward, as we look to semi and to the broader industrial markets, there is reason for optimism with some of the fab programs and the absorption of capacity that was put in place in prior years. Again, likely to be more back-end loaded. We've talked about at the Keysight level a gradual improvement through the year. And so, as Satish just said, we would expect, there is an opportunity for EISG, which has not yet returned to order growth, to do so in the back half of the year. And I think that would be with, some significant increase in the strength of the semi markets and some modest recovery in industrial end markets.
Got it. Thanks, Neil.
Thank you. The next question is from Mark Delaney with Goldman Sachs. Your line is now open.
Hey, thank you for taking my question. You have Will on for Mark Delaney here. Just one on M&A. So with the proposed Spirent transaction still ongoing, would Keysight be open to doing other larger transactions in the near term if one that made business and financial sense was available?
Yeah, I would just say, look, we have reiterated a very strong organic growth strategy that we're focused on realizing. We've also identified specific markets that we have studied to pursue a selective M&A. And at this point, while we continue to evaluate targets, we always remain disciplined and we'll look at them. But it's not a matter of capital as much as bandwidth to pursue more deals, given the deals that we've already announced, which we're working through.
No, it shouldn't be helpful. Thank you for that. And just one more on capital allocation. How should we be thinking about buybacks for fiscal 25? Any cadence commentary or any color that you can add there would be helpful. Thank you.
Yeah, the only thing I would say is that obviously we look forward to the close of the Spirent transaction, which will be a significant capital outlay for the company. But we do expect that we will, at a minimum, continue with our buyback program at least the anti-dilutive level, and then we'll be trying to strike a balance between, starting to get the cash ready to close the Spirent transaction, trade it off against what we might see as opportunistic opportunities to do more on the buyback front.
Thank you. That concludes our question and answer session for today. I would like to turn the call back to Paulenier Sims for any closing comments.
Thank you, operator, and thank you all for joining us today. Have a great day.
Driven by a normalization of marketing expense, as well as modest reductions in administrative costs. Adjusted SG&A expenses decreased by $5 million year over year to $66 million. Adjusted EBITDA for 4Q24 decreased by $10 million or 10% year over year to $92 million. The adjusted EBITDA rate for the quarter increased 10 basis points year over year to 26.3%. Net income for 4Q24 decreased year over year by $11 million to $28 million or 19 cents per share. Adjusted net income for 4Q24 decreased year over year by $9 million to $42 million, or adjusted diluted EPS of 29 cents per share. Now turning to our segment results. Residential segment net sales for 4Q24 were $327 million, down 6% year over year, driven by the previously discussed timing of channel partner purchases to achieve higher service levels in the prior quarter. Residential segment adjusted EBITDA for 4Q24 came in at $86 million, down 7% year over year. Residential segment adjusted EBITDA margins were 26.3%. Commercial segment net sales for the quarter were $21 million, down 47% year over year, primarily due to the sale of the Viacom business earlier in the fiscal year. Commercial segment adjusted EBITDA for the quarter came in at $5.8 million, a decrease of $3.4 million year over year, again primarily driven by the disposition of the Viacom business. From the balance sheet and cash flow perspective, we ended the quarter with cash and cash equivalents of $164 million and approximately $373 million available for future borrowings under our revolving credit facility. Working capital, defined as inventory plus accounts receivable minus accounts payable, was $216 million, up $19 million year over year. We ended the quarter with gross debt of $529 million, which included approximately $89 million of finance leases. Net debt was $365 million, and our net leverage ratio stood at 1x at the end of 4Q24. Net cash from operations was $60 million during the fourth quarter, a decrease of $66 million year over year. Capital expenditures for the quarter were approximately $23 million. For the fourth quarter, free cash flow was $38 million, a decrease of $54 million year over year. As previously announced, we initiated a $50 million accelerated share repurchase in August. Under the terms of the agreement, the company received an initial 1 million shares, with final settlement expected in the first quarter of 2025. The company also repurchased an additional 448,000 shares in open market transactions for an aggregate purchase price of approximately $18 million. The remaining authorization under our share repurchase program is approximately $560 million. Our capital allocation priorities remain the same as we previously communicated. We will continue to invest in our business both organically and inorganically, and to the extent we have excess cash flow, we will look to repurchase shares opportunistically. As we turn to the outlook, let me provide some context and color on our key planning assumptions for the upcoming fiscal 2025. We are assuming for the full year 2025 that the R&R market will be approximately flattish. Even with a flat market, we are incredibly confident that our AZEK growth playbook and specific AZEK carryover wins will enable us to continue to drive above market growth. Our planning assumptions have incorporated the potential impact of retail and pro channel activity for the year. We expect to grow our residential net sales by approximately 6% year over year in fiscal 2025 at the midpoint of our planning assumptions. The sum of these carryover impacts and growth assumptions drives our high-level planning assumptions for fiscal 2025 to $1.51 billion to $1.54 billion in revenue and $400 million to $415 million in adjusted EBITDA. Our net sales guidance range would imply 5% to 7% year-over-year growth and 5% to 9% year-over-year growth in our adjusted EBITDA. Our residential segment planning assumption for the year is $1.439 to $1.466 billion in net sales and $388 million to $401 million in segment adjusted EBITDA, representing 5% to 7% net sales growth year over year and 6% to 10% segment adjusted EBITDA growth. A few other assumptions for fiscal 2025 to share include the following. We are expecting a capital expenditure range of $85 to $95 million, consistent with our publicly stated target of CapEx of approximately 5% to 7% of revenue. We are expecting depreciation of approximately $94 to $98 million. We are expecting interest expense of approximately $27 million to $31 million. We are targeting working capital approximately flat as a percent of sales at 15%. And finally, as detailed earlier, we are expecting a GAAP tax rate for the full year of approximately 27%. For additional planning assumptions to assist with modeling fiscal year 2025, please refer to the supplemental earnings presentation we had posted on our investor relations website. Before we turn to our guide for the first quarter, I wanted to provide context for the operating environment we expect in fiscal 1Q25. For the quarter, we are expecting residential sell-through growth in the mid to high single-digit range. From an inventory staging perspective, we expect our channel to remain conservative and exit the first quarter with channel inventory at or below historical days on hand, in line with the last couple of years' behavior. As a reminder, this is the period of the year in which the industry negotiates shelf space positions and stages inventory in the channel ahead of the upcoming building season. AZEK historically ships channel inventory replenishment, otherwise known as early buy, in our second fiscal quarter, and we are assuming that effectively all of this volume will ship in fiscal 2Q25. Channel inventories were positioned conservatively at fiscal year end, and we are proactively managing our own finished goods inventory levels to maintain high levels of service. I want to note that our guidance does not include the impact of our Western distribution alignment, which could be modestly favorable for the first half of 2025, where we are not certain of the timing between fiscal 1Q25 and fiscal 2Q at this time. From an operating perspective, we expect continued stability in our manufacturing environment. We expect stable and non-inflationary material input costs, production levels relatively flat compared to the prior year, and continued progress against our productivity initiatives. Taking these factors into consideration, our guidance for the quarter is $260 million to $266 million in revenue and $58 million to $60 million in adjusted EBITDA. Our net sales guidance range would imply 8 to 11% year-over-year growth and 6 to 9% year-over-year growth in adjusted EBITDA. As a reminder, our prior year 1Q24 results included 1 month of our Viacom ownership, which contributed approximately $3 million of net sales and negligible adjusted EBITDA for the quarter's results prior to the divestiture. Our residential segment guidance for the quarter is $247 million to $252 million in net sales and $57 million to $59 million in adjusted EBITDA. Our net sales guidance range would imply 11 to 13% year-over-year growth and 9 to 13% year-over-year growth in segment adjusted EBITDA. We are expecting an effective tax rate of approximately 27% for the quarter. Our team is excited, engaged, and well prepared to tackle the environment in front of us in fiscal 2025. With that, I'll now turn the call back to Jesse for some closing remarks.
Thanks, Pete. We delivered another strong year of financial performance thanks to our dedicated team members, channel and supplier partners, contractors, and homeowners that share the same vision as the AZEK Company. We are well positioned to drive growth in fiscal year 2025 and double-digit growth and margin expansion over the long term by continuing to execute our strategy. With that, operator, please open the line for questions.
Thank you. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 again. Please limit to just 1 question per caller so we can get to everyone in the queue. Your first question comes from the line of Matthew Bouley with Barclays. Please go ahead.
Good evening. You have Anika Delakia on for Matt today. Thank you for taking my question. So I just wanted to hone in on sell-through a little bit. On your fiscal year 25 assumption for mid-single digit sell-through, wondering if you can parse out how we should think about this in terms of deck versus exterior. And then wondering if there's any read-throughs from higher channel partners or thinking about inventories or just their overall outlook for 2025. Thanks.
Yeah, thanks for the question. I'll just start with, as we highlighted, 5% is very similar to the number we started with last year at this time. It's assuming a zero growth market. And then on top of that, we have an intent to drive growth above that. And so that's how you get to the 5%. We're not necessarily parsing out between the two businesses. I think if you look at our track record over the long horizon, the two businesses have been relatively similar. I think if you look at us in our most recent quarters, you would see decking being a bit higher as we have called out, than our exteriors business. So, it's safe to assume, that modestly decking might be higher, but once again, we're not at that level of specificity. And then relative to channel sentiment, it's positive. I think people are waiting for the season to unfold. We've had good demand in the quarter that we're in. We ended last quarter with good demand. And I think they're setting up, similar to this year for us, they are setting up to have a relatively normal year. And I think they're approaching their buying patterns and how they view the opportunity in a very normalized fashion. So you should expect, and we expect, a pretty normal progression as we go through 2025.
Great. Thank you. Good luck.
Thank you.
Our next question comes from Susan Maklari with Goldman Sachs. Please go ahead.
Thank you. Good afternoon, everyone. My first question is thinking just a bit about the SG&A as we move through the year, given the new product launches and the efforts to support some of these distribution wins. Just any thought on the marketing, the sales effort, and how that will flow through over the next couple quarters?
Yeah, I think one of the things that we did very well this year was continue to invest and double down on growth opportunities within the marketplace. And what gave us that flexibility was the strong execution on the gross margins. And I think that's a philosophy that we would carry forward to 2025. Any extra strength we might see in gross margins, we would want to withhold the right to continue to invest some of that back into growth on the SG&A side. So I'd say more of the same, Sue.
Yeah, and I think, and I called it out in our prepared remarks, we have been launching new products and bringing new solutions to the market pretty consistently over the last few years. That, I would say, is embedded in our SG&A. It's part of how we operate. And so this level of activity, albeit a little higher this year with the terrific new product launches we have, is not unusual for us in that we constantly invest in expansion.
Okay, that's helpful. And then, you mentioned that your overall guide implies a flat R&R, so there's potential that you could see some upside there if that does end up being a bit stronger than you expect. What are you thinking of the setup that could drive some of that recovery in R&R? And how do you think about the potential that decking could outperform just broader R&R on its own in there, and what that could imply for your growth this year?
Yeah, I think in general, if you step back and you look at our growth thesis, and once again, we've got a 10-year track record now of 12% CAGR. If you look at that growth thesis, it's typically R&R. On top of that, you get a benefit in material conversion, which benefits us on both of our products. And then you get a bit more of an emphasis on outdoor living, which historically has outgrown that. And then, of course, you've got company-specific initiatives. So all of that is what historically we've stacked up to our 11+% growth algorithm. So I think as we look at the market moving forward, there's certainly a fair amount of third parties that are talking about increased R&R growth. I think for us, as we come into the year, we just think it's prudent to assume flat. It would be unusual to have 3 straight years of either flat or negative in the R&R space, almost unprecedented. But as a planning assumption starting out, similar to what we did last year, we think it's appropriate to assume a flattish market and then see where the market ends up.
Yeah. Okay. Thank you both for the color. Good luck with everything.
Appreciate it. Thank you.
All right. Our next question comes from the line of Michael Rehaut with JP Morgan. Please go ahead.
Hi, everyone. This is Andrew Ozzie on for Michael Rehaut. Appreciate you taking my questions. I would love to get a better sense of how sales are trending by price point, maybe within your good, better, best category framework.
Yeah.
This is Peter. Just, in terms of, premium versus entry, what I would say is, look, we're not seeing anything meaningful from a mix down perspective. That's been pretty consistent all year. The premium category growth rates are robust. Our good category, as we've called out for the last couple of quarters, is growing modestly faster, and we view that really as share pickup. We've been out of that entry price point largely coming out of the pandemic when we didn't have capacity, and we've relaunched kind of Prime and Prime Plus and supported that with capacity, and that's paying dividends.
Thank you. I appreciate that. And then, if I could get a rough sense of the sales impact from kind of your distribution expansion within Canada and even very recently your partnership with Capital Lumber in the West, would love to get some way to think about kind of the sales impact from that.
Yeah, at a high level, we haven't necessarily called that out. I think if you look at what we talked about on the last call in Canada with Doman, that gives us access where we had single distribution, and we now have double distribution, and it gives us access to the western part of Canada. I think on the capital front, it really sets us up with their downstream focus to continue to drive more conversion. I think what Pete called out in his prepared remarks is we do expect some benefit in the first half of the year from our Western distribution expansion. And, so we will see some incremental volume as we progress in Q1 and Q2. That would potentially be upside to our guide. And just to frame that a bit, it's about approximately $10 million, and that's potential upside of $5 million within Q1.
Got it. Very exciting. Appreciate it. I'll pass it on.
Our next question comes from the line of Tim Weiss with Baird. Please go ahead.
Hey guys, good evening. Nice job. I guess maybe just first question, Jesse, if you just kind of step back and you look at the sell-through numbers, kind of re-accelerating here, kind of Q3 to Q4, and I guess into Q1. Anything as you've kind of looked at data or kind of talked to your channel partners that would kind of drive the reasons behind that re-acceleration?
Yeah, first, it's a good question, and we have chatted with a number of channel partners. Historically, when we came into August, late July into August, there would be a little bit of a pause, in particular, and think of Long Island and the Cape and areas where people are vacationing. There'd be a bit of a slowdown in demand, and then seasonally that demand would pick back up as in the fall. Think of September, October, and if the weather's good, into November. And I think as we've seen this play out, it seems to be going back to a more seasonal pattern. Almost a back to school kind of last working on the house pattern on the DIY side, and then a similar set of activity in the contractor side. So I think we've seen positives throughout the year, and this pattern of a little bit of a slowdown in August and a bit more of a reacceleration in the fall is not unusual. And we view this whole thing as coming back to normal. You might see and hear that there may have been a pause related to the election. I don't know that we can see that. We saw that pattern of things coming back prior to the election.
Okay, that's helpful. Thanks. And then just, I guess, as you kind of look at the price cost equation, Pete, kind of in fiscal 25, and any kind of puts and takes you would kind of outline there?
Yeah, I'd just say similar to 24. I'd say the assumption on the pricing side for 25 is not quite back to normal pricing on decking, but closer to it. And as we saw in 24, we'll continue to have a little bit of backside kind of program management, primarily on the exterior side.
and that kind of 100 to 150 basis points. So let's call it net pricing positive, but negligible, probably less than a point.
Okay.
And
Okay, very good.
right now, just from a commodity perspective, it's the best news, I guess, that it's kind of boring right now. That ultimately a couple of months ago it felt like there might be some inflation creeping in, and in the last 45 to 60 days, it feels like more of a stable deflationary environment, if anything.
Okay. We'll take boring. Thanks a lot, guys.
Great. Thanks, Tim.
Our next question comes from the line of Phil Ng with Jefferies. Please go ahead.
Hey, guys. Congrats on a solid quarter and strong finish to the year. I guess if I had a nitpick, I mean, certainly margins, you guys are calling for decent margin expansion, call it 20 to 60 basis points, but I would have thought with all the self-help initiatives, you could drive perhaps more than that. You did kind of allude to maybe some investments. Can you, Pete, perhaps call that out, how much of a drag that might be or load in? And as we look out longer term, you're not far from your longer term margin targets. What are some of the levers that you have at disposal? Just remind us where you are with like the recycling and some of the product reconfiguration stuff.
Well, a couple of things that make sort of the fourth quarter a little bit unique. So obviously last year we called out, we had kind of a one-time benefit on some utility bills of about $1.8 million that didn't reoccur. We had the Lowe's kind of assistance on sort of the pricing on the transition on their inventory stocks. Those are a couple of things that are kind of both impacting the year-over-year kind of fourth quarter quality of earnings. But as we look out to next year, I think the opportunity set is still the same that we laid out at 2022 Investor Day. I think we've kind of said in general, a quarter or two ago, we probably executed against about half of that opportunity set. So there's still plenty of headroom across all three of the recycling opportunities, whether it be PVC deck, our exteriors business, as well as sort of our move to low density. We're making good traction on product configuration. And certainly, I think we demonstrated very well this year that every incremental pound of sales gives us incremental pounds of production, which gives us a tremendous opportunity to leverage those in the plants. And as Jesse mentioned earlier, certainly if R&R is better than what we pegged, traditionally we put out there an incremental margin rate of kind of mid-30s. And depending upon the magnitude of that upside, if it were significant, again, I think we feel really positive that our plants have responded well to incremental pounds of production.
And just your question on the target, obviously we're well on our way to achieving that by 2027. I think the way you should look at it right now is, and once again, it's within our control, investment, how we launch products, all of that. But you should look at it as we're on track to achieve that earlier.
Okay, super. And from a cash flow standpoint, strong cash flow, you guys bought back a decent amount of stock. When you look at the 2025, Jesse, how are you thinking about your priorities? Are you going to get back in the M&A market? Have you seen some opportunities out there that could be compelling, or versus buybacks? How do you think about it?
Yeah, at a high level, the priorities continue to be the same, which is, the best return we can get is if we see opportunities to continue to invest in the business. I highlighted that we acquired a small vinyl rail manufacturer. It was a relatively modest expense, and then we put a little bit more investment in there. Those sorts of, call it tuck-ins or adjacent, whether it be in recycle or whether it be in core or near adjacent products, those where we can add value are just terrific uses of our capital. We continue to invest 5 to 7% of our money, against capital projects. All of those are really beneficial. And then, as you point out, we actually, by retiring debt, that gives us some opportunity to even be more efficient relative to cash generation with lower interest. That leaves money left over, and I think as we consider it, we have been actively evaluating a number of acquisitions. We love our current business model. and I think it's important that anything we do is additive and fits our same Investor Day page, and so that's a pretty high bar. But once again, we found great opportunities, the one in May, and we expect that we'll continue to find smaller opportunities, and we'll see if there's something more significant that would fit it. So we're looking.
And I'd just add that anytime good recycling assets come on the market, you should expect us to be aggressive. The returns are great, and candidly, it's a way to extend the moat on our business and keep the verticality of our supply chain intact. From a repurchase perspective, similar to the last 2 years, if we are not able to deploy on M&A, because we're going to remain disciplined, we will be both programmatic as well as opportunistic on the share repurchases against that new program that we just approved last quarter for $600 million.
Okay. Appreciate the color, guys.
Thanks, Phil.
Our next question comes from the line of Keith Hughes with Truist. Please go ahead.
Thank you. I think you had said, Jesse, in the prepared remarks that sell-through was double-digit in October. If that's correct, I mean, that's a notable improvement from what we saw in the summer. Are there any products that in October that are moving, or is there something about this that's unique and one time in the month?
I wouldn't say it's one time. If you think about the previous answer to the question, there's always seasonality related. Maybe there was a pause over the summer that accelerated, and so there's always some dynamics. But in general, if you look at the pattern that we had, we saw nice sell-through growth in a lot of our products.
Okay, great. Thank you.
Our next question comes from the line of John Lovallo with UBS. Please go ahead.
Good evening, guys. Thanks for taking my questions. The first one is, I thought when we spoke last quarter, there was a mention of $40 million of carryover from Doman and Lowe's expected in the first half of the year. Did I remember that incorrectly? If not, I mean, what does the cadence of that look like in the first half?
Yeah, I would say high level. The way to think of it is coming into this year, we have talked about carryover on an annualized basis of a number of different things. Obviously, whatever shelf gains we had in the Pro during the year, that carries over. Whatever shelf gains we've had in other areas, that carries over. And then additive to that is if we're able to turn some of these distribution additions into shelf gains at a dealer and contractor level, that also carries over into the year. And then add to that, some of the things I just described are also interrelated to new products. And so we had new products that launched last year. We've got new products that launched this year. And as those products come to market, that gives us a bit of a tailwind because they need to be placed within the market. And then the last tailwind is really around our contractor and consumer wins. We added 2,000 contractors into our system in the last fiscal year. And we've had major step-ups in consumer engagements with samples and contractor leads, meaningful step-ups there. So when you think about tailwinds coming into the year, we're not going to specifically, call out an aggregate number. But I think the wording may have been, we're coming into this year with as high a confidence relative to the initiatives and the potential benefit in 25 as we've had in any other year. And, as that manifests itself, there's typically a little bit of fill on some of the distribution expansion. And then the rest of it flows through as the demand patterns emerge throughout the year.
And I just add, John, on the first quarter, if you looked at the difference between sort of sell-through and sell-to, that is not early buy. That's basically what you're asking about. It's the load in on those two opportunities.
Okay, got it. And then just on that first quarter guide, it looks like it implies about an 18% year-over-year incremental margin, versus what's normally closer to kind of mid-30s. Is there some investment spending going on there? What's kind of negatively impacting the incremental?
I mean, candidly, our ceramic products business is down a little bit year over year. There's been a little bit of inflation in that business, and we've taken pricing here now to kind of get that back.
Okay, thank you, guys.
Thank you.
Our next question comes from the line of Mike Dahl with RBC Capital Markets. Please go.
Hi, thanks for taking my question. I want to go back to the gross margin side, and I think Phil kind of asked around it, but just can you help us quantify? You alluded to some of the gross margin headwinds as the new products ramp. What specifically are those? And then the bigger picture question is, to the extent that some of these launches to expand your addressable market are expanding kind of your good part of the portfolio. So even if you're premium vinyl, premium steel relative to the market, it's still in, a different part of the market than you've played in the past. How should we be thinking about the margin profile on things like steel railing or vinyl railing or the paintable trim?
Yeah, so I think if you step back, anytime you launch a new product platform, with the exception of if you change a color in decking, but almost any other new product platform has a ramp, right? So you start making the product, you make it at lower production levels, you scale that up, and even the running of trials for that product. So while you're tweaking the product, et cetera, you run higher scrap. All of that is an investment in the expansion of a new product. So when you're thinking about new products and investment, to some extent, we're always doing that. I'm just highlighting that it's something that we're offsetting, and we always offset as we expand our margin. And then the long-term margin opportunity with the products we launch, we design our products in such a way, for the most part, that when we add a product to the portfolio, either near launch or we see a path towards getting to an appropriate margin for us. So, and that's the vast majority of products we're going to play in that same domain. And if you look specifically at a vinyl rail product for us, we have the ability to use recycled PVC. We blend our own PVC internally. And we also have a specific cap stock, and we're pretty good at extruding and manufacturing PVC. So even though we're coming into a different part of the market, not dissimilar from decking, we're bringing a lot of expertise and capability that will allow us to provide a terrific value for the consumer, but also put us in a really good position to continue to grow with good margins.
Thanks, Jesse.
Our next question comes from the line of Adam Baumgarten with Zelman & Associates. Please go.
Hey, guys, thanks. Just to clarify on SG&A, Peter, do you expect similarly, I guess, relative to history, elevated levels on SG&A in fiscal 25? And if that's the case, when do you think you'll really be able to kind of unlock the SG&A leverage more meaningfully going forward?
Yeah, I think that next year we will still achieve some modest leverage in SG&A.
Okay, got it. And then just curious on the near-term opportunity in railing. I know you mentioned the vinyl product. One of your large competitors has some pretty bold plans in that part of the market. Maybe how are you thinking about the railing opportunity outside of just the size, which that was helpful, but the railing opportunity for AZEK specifically, and maybe how your strategy could be a little bit different, or maybe it is similar?
Yeah, this is an area that is very core to us. And so we're deck, rail, and accessories. 6 years ago, we bought an aluminum rail company that has scale to be one of the best aluminum solutions. We bought a premium PVC rail company with Intex. We have differentiated technologies in PVC which puts us in a position to be able to be very competitive in many parts of the market. So for us, when we look at rail, it's just core. There was a few product offerings where we didn't, as we mentioned, good, better, best. We weren't necessarily where we wanted to be on the good side, and so we have addressed that with these most recent launches, and we just feel like we're in a really good position to continue to do in rail, in exteriors, and in decking what we have been doing, which is launching these new products, converting more of the market, securing more channel presence, and giving our customers the right alternative where we can provide them with a solution. And that's been very helpful as we've expanded and worked with our core distributors and new distributors. It's been very helpful as we engage our channel partners and our contractors.
Okay, thanks. Best of luck.
Yeah, and the only other thing I would say is in the last couple years, we haven't called it out specifically. Rail has been a really nice contributor to our growth.
All right, our next question comes from the line of Ketan Mamtora with BMO Capital Markets. Please go ahead.
Good afternoon, and thanks for taking my question. You've talked about sort of your R&R assumption. I'm just curious, as you think about the exteriors business, have you, sort of from a planning purposes, how are you thinking about new resi growth? Because if we see sort of demand pick up there, it could help your exteriors business. So how are you thinking about that?
It's a good question. I think in aggregate, we're thinking of both sides of the business as, for lack of a better term, status quo. We're not baking in, an assumption of acceleration in either market.
Understood. Okay, that's perfect. I'll turn it over. Thank you.
Great, thank you.
Our next question comes from the line of Kurt Yinger with D.A. Davidson. Please go ahead.
Great, thank you. I just wanted to spend a minute on the competitive landscape, and you've discussed some of the distribution shifts. You guys have taken a not insignificant amount of retail business from some of your smaller peers here. Presumably that will yield some competitive response. I guess, how are you thinking about the opportunity set out there going forward to continue to consolidate market share kind of on the offensive side, and then while also being mindful of how others may react or respond and from kind of a defensive perspective?
Yeah, so the short answer is our focus is really on growth in the market, and the best opportunity we see for growth in the market is putting ourselves in a position where we can drive more conversion in the market. We had that rail discussion just the earlier question. 65% of the rail market is wood. Decking still 75%. Trim has a meaningful percent that's in wood or wood-like products. And so for us, as we're evaluating expansion in retail, pro, distribution, we're really looking to set ourselves up in a way that can drive growth for ourselves and potentially growth in the marketplace. I think as you look at the landscape, there's always competitive movement, and I think for us, our goal is to be a net beneficiary of movement in the channel, whether that be pro or retail. And we're in a really good position, we believe, to really continue to expand and benefit from transitions that are going to occur in the marketplace.
Got it. And maybe just following up on that material conversion dynamic, it's maybe a little bit lost in all of the other discussion, but beyond kind of year in, year out marketing at the consumer level, what else do you think is important in continuing to expand kind of that dynamic?
As you highlight, there is consumer engagement. There are a lot of decision makers involved in the process of choosing a material. It's really important that it's not just the consumer we engage, but all of the support infrastructure that a consumer, and in particular high-end consumer, would use. So there's an investment there.
Call for questions. Our disclaimer can be found on slide 4, as some of the comments today are forward-looking and subject to certain provisions and are subject to risks and uncertainties as well. You can find the full disclaimer statement in our periodic filings with the SEC, as well as the earnings press release itself today. With that behind us, I'll now turn the call over to Rick Dowk. Rick?
Thanks, Dan. Hello, everybody. Thank you all for taking the time to join us today. During the third quarter, we made important progress along several fronts here at Workhorse. Let's turn to slide 5 and jump right into the presentation. Commercially, we achieved a critical, validating milestone in July, securing a 3-year master framework agreement with FedEx. This is absolutely a game-changing accomplishment for us here at Workhorse. Let me put this accomplishment in a little bit of perspective. This new relationship, like most in business, has been established over an extended period of time. More than 2 years ago, we met with the FedEx EV team in Memphis. A year ago, the FedEx executive leadership team came to our plant up in Union City and met our operating commercial teams and drove our trucks. And a few of them even visited our stables operation where we test our trucks and operate them as actual FedEx ground contractors outside of Cincinnati. This led to a 50 W56 step van demo undertaken down in Memphis in Q2 of this year, which was fully successful. And our truck got one of the highest ratings that FedEx team had ever given to an EV company. This led to negotiations and the signing of a framework agreement for a 3-year master supply and service agreement, which was followed immediately by the initial purchase order for 15 W56 step vans that we delivered for upfit in Q3. It's hard to overstate the importance of this agreement for an emerging commercial EV company like ours to become one of FedEx's approved commercial vehicle suppliers in the EV segment. FedEx has publicly committed to convert their greater than 150,000 unit last mile delivery fleet and ground support fleet to EV vehicles by 2040. A large percentage of those vehicles are what are referred to as P1000 cargo step vans across the industry, exactly the segment that we designed our W56 step van to replace over the next 1 to 2 decades. So we've broken through, we got our first PO, and we hope to keep growing. In October, we were selected as a presidential level exhibitor at the 2024 FedEx Forward Service Provider Summit in Orlando. We had a 56 plan for the ride and drive, so rather than ship the truck down, we drove it to Florida. The trip was approximately 1,000 miles from our plant, and the truck demonstrated its robust capabilities driving through the remnants of Hurricane Helene, across the Appalachian Mountains, and through heavy Atlanta rush hour traffic. 3 unique and challenging tests for any vehicle, not just EVs. This showcase event has led to 75 new quote inquiries to date from FedEx ground contractors across the country. And as we announced a few weeks ago, we now have 3 firm purchase orders from ISPs for the delivery of 7 vehicles in Q4, and we're working on converting some of those inquiries to additional orders in the near future. Our progress with FedEx, both with the corporation and with the FedEx ground contractors, confirms that our product strategy, centered around providing reliable, capable, and well-built products tailored for the Class 5 and 6 commercial market, coupled with our engineering, design, supply chain, and manufacturing capabilities, could produce a market-leading EV step van that would meet the needs of highly demanding and selective customers like FedEx. We have done just that, and now we look forward to earning even a larger FedEx order in 2025. In addition to our breakthrough commercial win at FedEx, we are also seeing increased activity in government-funded fleet opportunities. Just last week, we were awarded a GSA contract following a successful site visit to Union City where the GSA audited and validated our production capabilities, our quality systems, as well as our product testing and inspection processes. This award was many, many months in the making, and now we have achieved the milestone that allows federal government agencies to streamline the procurement process for the W56. It opens up yet another important door for our go-to-market capabilities. Obviously, we are closely monitoring how the recent presidential election may influence or change the mandate to electrify the federal fleet in the coming months, and we'll keep you up to date as we learn more. At the state levels, the Sourcewell contract for procurement in the category of Class 4 to 8 chassis and cabs with related equipment, accessories, and services for our W4CC chassis has resulted in a meaningful uptick in quoting activity. In the past 90 days, there are now 5 pending bids out for more than 300 Class 4 units at the moment, and our dealer network is pursuing 21 city and county quotes for a total of additional 44 truck orders. We were also approved by the Florida Sheriff's Association Cooperative Purchasing Program for local government and education entities in the South. Finally, we have had successful vehicle demonstrations for 2 additional major last-mile fleets during the quarter. You would recognize their names, one in the industrial linen business and the other supporting package deliveries outside the United States. Despite the need to proactively conserve cash and reduce costs across the organization, which Bob will touch on later, we have managed to continue to expand our product line, grow to meet our customer needs, and call on more customers. A lot of the engineering being completed is being driven by direct customer feedback after multi-week and multi-application field demos with our customers. And the customers like the fact that we're very responsive and we give them real support. Let me shift to slide 6. Last quarter, I spent a fair amount of time outlining the commercial EV backdrop, corporate EV commitments, California regulatory dynamics, and the like. The recent election has understandably focused attention on the clean tech space in general and the EV market in particular. So I thought I would spend a few moments discussing why we believe that integrating EVs into commercial last-mile delivery fleets is not a political issue where sides need to be taken.